Okay, guys, mortgage rate tipping point. Homeowners say roughly 5% is the magic number in order to move, but then in the same article, they reference the 5.5 mark a couple of times. So, Brian, you've mentioned golden handcuffs, and that's brought up in here. And, I mean, look, right out the door, they're saying nearly 82% of homeowners feel locked in by their existing low-rate mortgage, according to data from Realtor.com.
Well, Andy, actually, before we go even farther, I want to ask Brian, isn't it kind of funny how they say 5% is a new magic number, but maybe back in January, if you quoted 5%, someone might be like, well, why? Why can't I get 4.5? Why can't I get 4.25? It's like, look how much the market has changed in just 9 months.
But it's look ridiculous. How much they're conditioning people, though. They're telling them this rate. So later on, when they do ask you, like, they know what the rates are. They're seeing it everywhere. And I just feel that that's what we need more, so people can really understand the climate of the real estate market and really make their assumptions or their goals based off the real numbers and not just stuff that they got told in conversation or is just black data from, that's not accurate.
Yeah. And this is the number that they were saying we would be looking at the end of 2023, which we will not be looking at the end of 2023. I mean, look, to go from where we're at now in this 7.25, let's just call it 7.25 for the purpose of our conversation today. Let's say we're 7.25 on the average, and then we got to get to 5.5. Like, that means that something really bad happened between now and the end of 2023 that would cause that to happen.
Yeah, so I've been hearing a lot in discussion a black swan event. I've been hearing something that, Ed, if only this happened, this is the only way that things could magically, change, or, we might have to step in and lower rates. So that's something that I'm not saying is going to happen, but I have been paying close attention to because I've heard it from multiple news sources that are pretty credible. And I'm just interested, okay, is there something in there?
So let me ask you the question. In referencing Black Swan references a type of event that would occur. Which types of events are they suggesting might be the Black Swan?
I mean, the pandemic.
A miracle.
Well, that's yes.
I didn't want to use the P word.
I guess let me rephrase it. Economically, what would be an example of a black swan event that might undermine or compromise the rest of the system?
Possibly huge, job losses.
Job losses, okay, that's a good one.
Major job losses where people honestly can't pay their bills, and now it's just more than just the unemployment rate completely goes up.
Yeah, student loan debt I think is not being considered. I know that's a very specific one. It's a bit more nuanced.
Auto loan debt.
Auto loan debt, and I don't think, and again, auto loans and student loan debt are a mix of probably what companies are, lending out, right? It's not just, and I mean, there are cases where that is all I do, I just lend money for this or money for that, and there's we lend across a lot of things, so I think
consumer credit in general is
there's variety of risk depending on who it is that's holding all that debt. That's an issue. I think, I mean, on the long view, I'm looking at stuff like BRICS and the emergence of new baskets of currency that are undermining the U.S. dollar long term. And just as a caveat for all you guys watching, the U.S. dollar is connected to way too many things to just turn it off with the flip of a switch. That's not going to happen. But they are already working towards other alternatives to have economy exchange between other countries that don't include our dollar. So those are some of my ideas for Black Swan. Massive unemployment, of course, would potentially threaten housing. But again, there's equity. So people could sell and just get out from underneath whatever their financial challenges are. If they have $100,000, $200,000, $300,000, $400,000 of equity, problem solved, at least in the moment, not long term. So
makes sense.
What do you think, Mikey? What would be a Black Swan event you'd be looking for?
Yeah, in my opinion, to be honest, we need more unemployment. People need to stop spending. That's literally the only way we're gonna see that.
Brutally honest.
Just straight up for us to see a 5.5. I mean, even by Q2 in 2024, I think we need a miracle, right?
It does seem like it's far enough away on the horizon, but I have to remind myself, we're here in September of 2023 and they started rate hiking in March of 22. So, here we are, what is that, 17 or 18 months, whatever, 17, 18 months beyond when they started this. So I can't honestly say we're going to be back to anywhere the normal, if you will, in less than 18 months. I mean, that'd be quite the boomerang, but
I agree.
At least in this article, they're talking about it being unlikely that rates are going to drop anytime soon. I think it's a little bit of a falsehood that homeowners would be nearly twice as willing to sell their house if rates were at 5%. Willingness has a lot to do with the money and the cost, but also life circumstances and what's going on. So, I think that's a little bit of leveraging the point in that sense. So, What else, Brian? What do you got from this one?
So for me, it was about the payment. So when they said that they wanted to come down to that like 5%, so I did just a little example based off, 720 credit score, 20% down on a 700K purchase, and at a 7.375, not quoting, just principal and interest was 3,867. That's a difference of, if we go down to 5%, $861, and your payment would be $3,006.
So you're saying it's $861 more expensive now than it would be if it was at 5%.
Yes.
For how much, to borrow how much?
To 700,000, 20% down, 140. So you're
a 560 loan.
560 loan, yeah.
Wow. So on 560,000, you would be at 3867
at a 7.375, which is more or less, average of what, the rates are at right now. And if it comes down to 5%, which is, the golden number, 3,006 for your principal and interest.
Wow. That's a pretty big, I mean, that's a significant difference.
What was the loan amount one more time? You said 560?
560.
Yeah.
560.
Jeez.
Yeah. Well, I know that this has like an inverse kind of relationship with listings. Well, not inverse. It's kind of a direct relationship. They're basically saying this is the high rates are incentivizing people to hunker down and do this whole golden handcuff thing. Like, oh, I'm handcuffed to this 3.5. Like, boo-hoo.
Dang it. Oh, my God. My house is full of equity.
I had this, like, maybe it's a snarky moment or whatever. I was reading that they had interviewed this grandpa, and he was basically saying, like, yeah, if rates were lower, I'd move to be closer to my grandkids. Like, sorry, grandkids. Grandpa can't spend the rest of his life with you because rates are too high.
Yeah, I noticed that, too.
Basically.
I was like, yikes. Maybe that's just me. And okay, so the other thing too, again, going back to referencing things of the Wayback Machine, between 1978 and 1981, mortgage rates similarly doubled from around 9% to more than 18%. And here we go again with these 40-year-old references that are only relatable to, a shrinking population, if you will. And again, like the house is maybe only $70,000. So fine, you got a 13% interest rate on $70,000. I know proportionally, but money was cheaper, things were less expensive, we didn't have as much inflation. That is also true. I understand that. But again, all things being equal, if you will, even on today's dollar compared to that dollar, the housing expense is way less affordable now than it was back then.
No, 100%. I mean, and these numbers, I feel they're not equal. They're not equivalent, and they're definitely not equal. I mean, it's a comparison, but at the same time, like you said, cost of living is way different, completely different situations. So many different things are happening in this life that I don't feel this is accurate for people to even be able to compare it to, because we're living in complete different times.
Yeah.
There was a reference that said, okay, LeBron James now, if he played back then in the NBA, he'd be the best player. But if the best player back then played in this world, in this type of environment, they wouldn't be able to compete because it's different times.
Yeah. The game has changed.
The game has changed.
Yeah.
There you go.
The game has changed. The game has changed.
Yeah. And Andy, I mean, I know this is from 1980, but even just going back to the early 2000s, for example, where I live right now, the community was built around 2005, I think. And so a lot of my neighbors, they moved in 2005, and they tell me, how cheap their housing payment is, this and that. And all I can think is, geez, like if they try to buy a house like this now, they'd be living in a 1-bedroom condo for that mortgage payment. It's crazy. And,
and I can go all the way back to 1987. My folks bought a house in Bonita in 1987 for $173,000. And that was high. That was really high at the time. And the rate was like 13%. But, they kept that house for nearly 20 years and then sold it for $750,000. And at that point, of course, rates were a lot lower, and they were actually in the fives back when they sold in 2007. But you're talking about $173,000 compared to $750,000. That's quite the equity gain. But again, there's reference point for you. Like, yeah, it might have seemed hard. That mortgage payment was hard for them in the beginning, but over the course of time, it was easier and easier. They made more money. Their loan balance went down. They refinanced when rates went down. So they made the most of it, and they did it for long term. I
think a counter argument to that is that everybody nowadays wants everything quick, instantly, and right now.
Yeah,
I feel before people were more patient. They'd be able to save up. They didn't want everything to happen yesterday, whereas now, thanks to everything happening in instant, you have this where, hey, I want to sell my house the next following year because equity's up. No, what if you hold on to it for 5-10 years, and then now you can actually have a significant growth?
And I think patience and commitment go hand in hand in this 100%. Case, because it's the patience to wait and it's the commitment to see it through. Because I would say it required both of them at that time. It wasn't just economically they had to stay there, and they weren't handcuffed necessarily. That's just the house that they committed to raise my sister and I in, which they did.
And I feel the values have also changed. Therefore, the style of buying and the way that we consume things has also altered the way that we go out and buy or look at certain financial situations that we make.
Well, and back to the top of the show, we're talking about non-married people who are buying houses together. That's the exact
Thesis
that
of it,
exact
yeah.
point. So.